All right, so let us do the question from section C. Okay, and it is related to the preparation of single entity financial statements. So let us first look at the requirements. So in the requirement, what they are asking, prepare the statement of profit or loss and other comprehensive income for Moston for the year ended 30th June 2005. 10 marks are we have prepared the statement of changes in equity for Moston for the year ended 30th June 2005. Finally, prepare extract for the statement of cash flows for Moston for the year ended 30th June 2005 in respect of the cash flows for investing in financing activities. Then we have 5 marks. Finally, total marks available at 20. So let us solve it. So here we have the trial balance extracts that is not a complete trial balance related to Moston. As at June 30th, June 2005, we have revenue, we have cost of sales, we have a note related to research and development, distribution costs, admin expenses, note 3, loan note interest and dividends paid, note 3 and 5, okay. Investment income, equity shares, note 5, loan notes 5%, note 3, retain earnings at 1st July X4 2004, revaluation surplus 1st July 2004, other components of equity, property at valuation 1st July 2004, note 2, plant and equipment at cost, note 2, okay, accumulated depreciation, plant and equipment 1st July 2004. Now, first note, that is Moston comments a research and development project on 1st January 2005. It spent $1 million per month on research until 31st January March 2005, at which date the project passed into the development stage. From this date, it spent 1.6 million per month. Okay, until the year end 30th June 2005, which the development was completed. However, it was not until 1st March X5. Director of Moston were confident that the new product would be a commercial success. Expense research and development cost should be charged to cost of sale. Just a second with yeah, the year end is 30th. Right, cool. So far, so good. Now, the next is Moston property is carried at fair value, which at 30th June 2005 was 29 million. The remaining life, okay, the remaining life okay. Remaining life at the beginning of the year, 1st July, was 15 years. Moston does not make an annual transfer to retain earnings in respect of the revaluation surplus. Ignore deferred taxation on the revaluation. Okay, cool. Uh, so research and development. Let us do the working first. The question is Moston company, and we will do the workings first. So research and development. Research and development cost is $4,600. Therefore, development costs can only be capitalized from the date the directors became confident that the new project would be commercially successful. Right. So that is the date is 1st May. Right. So research is $3 million. That is, 3 months at 1 million per month from January to March. Okay, that is, January to March, and April cost of 1.6 million should be expense. Is should need to be expense. So 0.6 million. Now remaining 3.2 million dollars. That means 2 months at 1.6 million per month will be capitalized. Okay, one thing. Second, we had Moston's properties carried at fair value, which is at 30th June. Okay, 30th June 2005 was 29 million. The remaining life of the property at the beginning of the year 1 July was 15 years. Moston does not make annual transfer to retain earning in respect of the revaluation. Ignore deferred taxation on the revaluation. What was the value of the building in trial balance? Here it is, 28,500. So it is revalued by 500. That means next is property, plant, and equipment. So property, plant, and equipment, right? Two things to do. What's that? previously, depreciation of property. Remaining life is 15 years. Will get the depreciation 1900. Okay. Now remaining, it is revalued by 500. Property, plant, and equipment 500, and the revaluation reserve divided 500. That's it. Okay. Next is depreciation of property, plant and equipment. So 27,100 previous depreciation till now 9,100, right into 15% will get 2,700 here. Okay, so far so good. We are done with the two adjustments till now, the first and second. Now we will move to the next one. The 5% loan note was issued on 1st July 2004, okay, at its nominal value of 20 million, incurring direct issue cost of 500,000, which have been charged to administrative expenses. The loan note will be redeemed after 3 years at a premium, which gives the loan note an effective finance cost of 8% per annum. Annual interest was paid on 30th June 2005. Okay, a provision for the tax for the year ended 30th June 2005 of 1.2 million is required, together with an increase to the deferred tax provision to be charged to profit or loss of 800,000. Okay, move on. We are done. Loan note. No, sorry, loan interest. Loan interest. 5% is the loan note, right? 20,000 minus 500 into 8%, we get 1,560. Okay, that is into the thousands, right? So 5% loan note issue should not be charged to admin expenses but deducted from the proceeds of the loan, leaving an initial value. The initial value of the loan is of 90, sorry, dollar 19.5 million. All right, then we are done with this one. The provision for the current tax, we will do this in the end. Then we have Moston paid a dividend of 20 cents per share on 30th March 2005, which was followed the day after by an issue of 10 million equity shares at the full market value of 1.70. The share premium on the issue was recorded in other components of equity. So let us solve this one. Dividend paid and share issue. So the dividend was paid prior to the share issue and is therefore calculated based on 20 million shares, right? So that means 30 million minus 10 million, right? And dividend paid 20 million at 20 cents. We get 4,000. Now the share issue is 10 million at 1.70. We will get 17 million, right? So 10 million capital, 7 million premium. Now we will have, we are done almost with the all our games except for the current tax, which we will adjust in the, uh, in our income statement and all. Let's do one additional working, which will be for your ease. That is for the cost of sales. We are already done with the depreciation and all. Okay, so as per trial balance, 88,500. Depreciation of property, we already did the working for 1900. Depreciation of plant and equipment, 27,100. So that we already did the working. So no need to do doubling, just 2,700. And finally, research and development. We already did the working, so 4,600. Total, our cost of sales is 97,700. Now, Moston, statement of profit or loss, other comprehensive income. For the year ended, thirtieth June 2005. So revenue as per the trial balance is 113,500. Cost of sales is the working 97,700. We already did the working on it. Right now we will get our gross profit. Okay, that is 15,800. Distribution cost 2,800. Admin expenses 6,800 minus 500. Loan note issue cost 6,300. Investment income 300. Finance costs, we already did the working 1,560. For tax, which is 5,400. Now, income tax, as I told, we will do that in here. So 1200 plus, the taxation adjustment or the provision we have to add here, that is 2000. Now profit for the year, 3440. Other comprehensive income, items that will not be reclassified to P&L, reclassified to profit or loss. Okay. Uh, Gain on revaluation of property, gain on revaluation 1000 minus 28,500 minus 1900, the earlier depreciation. We did the already in the working one. So we got 2400. Total comprehensive income, 5840. Now, finally, we have, next requirement, Moston, statement of changes in equity, year ended 30th June 2000 X5. We have share capital, we have other component of equity, we have revaluation surplus, we have retained earning, and then we have total. Now, balance at 1st July 2000 X4, 20,000. We have other component of equity 2300. We have a total of 3000 evaluation. We have 6200 retain earning, and the total is 31,500 here. Now, share issue, which is our working three. We had the share capital of 10,000. We have the other component of equity 7,000. Total is 17,000 here. Total comprehensive income for the year. One is revaluation reserve 2400. Next is 3400. Sorry, 3440. The retain earning and the dividend paid, which we did in the working, is 4,000. Finally, we are done with the 30,000, 9300, 5400, 5640, 5340. Oh, wow. So finally, now, most on statement of cash flow for the year ended 30th June 2000x5. So cash flow from investing activities, capitalized development costs, 3200, investment income, 300, and finally cash flow from financing activities, from financing activities, share issued, dividends paid, 4000, loan notes issued, 19500. So that's the solution for the Moston company, and I hope it is clear to you. Thank you.